When people think about gold and silver, most of them focus on price. They watch the daily charts, the headlines, the fear in the markets, and they believe that's where the real story ends. But history has always shown us something different. The biggest wealth transfers never happen when the crowd is paying attention. They happen quietly, underneath the surface, while most investors are distracted by noise. Right now, we are entering one of those moments. Central banks are moving differently. Debt levels are exploding worldwide. Confidence in fiat currency is weakening faster than many realize, and yet the majority of gold and silver investors still believe this market will behave like the past. It won't. What's coming next could reshape the entire precious metals market in ways most people are completely unprepared for. The investors who understand this shift early may position themselves ahead of one of the biggest financial turning points of this generation. Most people enter the gold and silver market believing they already understand the game. They think the opportunity is simple: buy low, wait for fear in the economy, and then sell when prices rise. That is how the average investor looks at precious metals. But the truth is, the biggest opportunity inside gold and silver has never been visible to the average crowd. It hides beneath the surface, buried under distractions, manipulated narratives, and decades of conditioning that taught people to trust paper systems more than real assets. The majority of investors spend their time watching daily price movements while completely ignoring the structural changes happening across the global financial system. They focus on ounces and charts while the foundations of the monetary world quietly begin to crack. What makes this moment different is not simply inflation. It is not only debt, interest rates, or recession fears. The real story is the growing collapse of confidence. Financial systems survive because people believe in them. Currencies survive because populations trust governments and central banks to preserve purchasing power. Markets function because investors believe the rules are stable. But throughout history, once confidence begins to weaken, the shift can happen much faster than anyone expects. Gold and silver become important during those moments not because they are trendy investments, but because they represent something governments cannot print endlessly. For decades, people were trained to think of gold as outdated. They were told modern economies no longer needed hard money. Central banks claimed fiat systems were stronger, more flexible, and more advanced. Investors were encouraged to trust stocks, bonds, and digital wealth creation. Precious metals became viewed almost like relics from another era. Yet behind the scenes, the largest institutions in the world never stopped understanding the true role of gold. Central banks continued accumulating it quietly. Nations kept reserves, wealthy families maintained allocations across generations. While retail investors chased technology bubbles and speculative assets, the people closest to power never fully abandoned hard assets. That alone should force people to ask questions. If gold no longer matters, why are governments buying it in record quantities? If silver is just another industrial metal, why does demand continue rising while physical supply struggles to keep pace? Why are nations reducing dependence on the US dollar while simultaneously increasing exposure to tangible reserves? These are not random events, they are signals. The problem is that most investors are still looking backward instead of forward. The average investor believes opportunity begins after headlines appear. They wait until prices explode. They wait until media coverage becomes nonstop. They wait until everyone around them starts talking about metals again. But by that point, the largest gains are often already behind them. The hidden opportunity always exists before the crowd notices it. That is where positioning matters most. History repeatedly shows that wealth is built during periods of disbelief, not during periods of public excitement. Look at human behavior during every major financial cycle. During stock booms, people become convinced prices can only rise. During real estate bubbles, they believe property values are guaranteed forever. During bull markets and technology, investors convince themselves that old rules no longer apply. Precious metals operate differently because they often move strongest when trust in everything else begins to weaken. That is why gold and silver markets can remain ignored for years before suddenly exploding higher in short periods of time. Most investors cannot psychologically handle those quiet phases. They become impatient, they lose conviction. They chase faster moving assets because modern financial culture conditions people to expect immediate gratification. The hidden opportunity in gold and silver comes from understanding that these metals are not merely investments. They are signals of monetary stress. They reflect confidence levels in governments, currencies, and central banks. When gold rises aggressively, it often says more about weakness in fiat systems than strength in metals themselves. That distinction matters because it changes how investors interpret the market. Most people still think gold and silver are speculative trades. In reality, they are forms of financial insurance against systemic instability. What most investors fail to recognize is how fragile the current system has become. Global debt levels are now beyond anything previous generations experienced. Governments continue spending at extraordinary levels. Central banks expanded money supply massively over the past decade. Entire economies became dependent on artificially low interest rates. Financial markets grew addicted to liquidity injections. The system now requires constant support simply to maintain stability. That creates a dangerous long-term problem because debt eventually reaches levels where repayment becomes mathematically impossible without currency debasement. This is where the hidden opportunity begins separating informed investors from the crowd. Most people assume governments will somehow solve these problems gradually. They believe central banks remain in control. But history suggests something very different. No fiat currency system has survived forever. Every paper currency experiment eventually faces the same reality. Excessive debt leads to devaluation, purchasing power declines, confidence erodes, hard assets regain importance. The cycle repeats because human nature never changes. Silver represents an even more misunderstood part of this equation. Many investors treat silver as merely cheap gold, but silver has unique characteristics that make it potentially explosive during periods of monetary and industrial stress. Unlike gold, silver serves both monetary and industrial functions. It is essential for electronics, solar technology, medical equipment, and countless industrial applications. Modern economies rely heavily on silver consumption, yet most people never think about where supply comes from or how fragile production chains can become. The hidden opportunity exists because silver markets are relatively small compared to other financial markets. That means even modest shifts in demand can create dramatic price movements. When investment demand collides with industrial demand, supply pressure intensifies quickly. Most investors do not understand how tight physical silver markets can become during periods of panic. They assume availability will always exist because financial systems train people to trust paper representations of assets rather than physical ownership itself. That psychological shift matters enormously. Over the last several decades, markets became increasingly digitized. Investors grew comfortable owning numbers on screens instead of tangible assets. Stocks became electronic. Banking became digital. Wealth became abstract. Precious metals challenge that mindset because they represent physical value outside the financial system. During stable periods, most people ignore the importance of that distinction. During unstable periods, it suddenly becomes everything. Another reason the opportunity remains hidden is because mainstream financial media rarely treats precious metals seriously until prices are already surging. Media narratives tend to reinforce existing trends rather than anticipate future ones. When metals are quiet, coverage disappears. Analysts mock gold investors as fearful or outdated. But once crises intensify, narratives shift rapidly. Suddenly, everyone begins discussing inflation protection, safe havens, and currency instability. By then, emotional buying often replaces rational positioning. The investors who succeed long term are usually the ones willing to move before emotional consensus forms. They understand markets are driven by psychology as much as fundamentals. They recognize that public opinion almost always lags behind structural reality. This requires patience because early positioning often feels uncomfortable. There may be long periods where nothing dramatic appears to happen. Prices may fluctuate sideways. Critics may dismiss the thesis repeatedly, yet beneath the surface, conditions continue building pressure. Central bank behavior provides one of the clearest examples. While public narratives promoted confidence in fiat systems, central banks across the world steadily accumulated gold reserves. That contradiction should not be ignored. Institutions closest to monetary power understand risks differently than average investors. They prepare years in advance because they know systemic changes rarely happen overnight. The public typically notices only after the effects become unavoidable. Another overlooked factor is generational psychology. Younger investors grew up during an era dominated by technology stocks, cryptocurrency speculation, and digital finance. Many have never experienced prolonged currency instability or serious inflationary environments. Because of that, they underestimate why previous generations valued hard assets so heavily. They see gold and silver as slow moving or boring because they measure opportunity primarily through short term percentage gains. But wealth preservation becomes far more important once financial conditions deteriorate. The hidden opportunity also comes from the disconnect between perception and reality. Most people still believe economic conditions are temporary distortions that policymakers can fix easily. They assume inflation will normalize permanently. They believe central banks can engineer soft landings indefinitely, yet every intervention creates larger imbalances over time. Debt grows larger, currency purchasing power weakens further, dependence on monetary stimulus increases, systems become more fragile, not more stable. Gold and silver investors who recognize these patterns early understand they are not simply betting on prices rising. They are positioning against long-term systemic deterioration. That perspective changes everything because it removes emotional dependence on short-term fluctuations. Daily volatility becomes less important when the larger thesis revolves around monetary transformation itself. One of the greatest mistakes average investors make is assuming opportunity disappears if prices already moved higher from previous lows. But major secular bull markets often unfold across many years, sometimes decades. Early stages rarely attract widespread public participation because memories of previous disappointments still dominate sentiment. Precious metals spent years frustrating investors, creating skepticism and fatigue. That emotional exhaustion is precisely what often exists before larger moves begin. Markets tend to transfer wealth from impatient participants to patient ones. Precious metals require patience because they operate differently from speculative momentum trades. They respond to deeper macroeconomic forces that evolve gradually before accelerating suddenly. Investors conditioned by modern trading culture struggle with that timeline. They want constant excitement, immediate confirmation, and rapid returns. Gold and silver often reward discipline instead. There's also the issue of leverage throughout the financial system. Modern markets rely heavily on debt, derivatives, and complex financial engineering. That creates hidden vulnerabilities because leveraged systems become unstable when liquidity conditions tighten. Precious metals historically perform well during periods when trust in leveraged financial structures begins breaking down. Most investors ignore those risks until crises emerge visibly. Physical ownership represents another hidden layer most people overlook. During stable times, paper claims appear interchangeable with real assets, but during stress events, counterparty risk suddenly matters. Investors begin questioning whether paper contracts truly represent underlying physical supply. That is why physical demand can rise aggressively during periods of uncertainty. People no longer want promises, they want direct ownership. The opportunity becomes even larger when considering how small precious metals markets remain compared to global financial assets. A relatively tiny percentage shift from stocks or bonds into metals could create enormous upward pressure because the available physical supply is limited. Most investors underestimate how quickly sentiment can change once confidence begins deteriorating broadly. Inflation itself is also misunderstood. Governments report inflation through official statistics, but ordinary people experience reality differently. They see rising food costs, housing pressures, healthcare expenses, and declining purchasing power. Over time, populations begin losing trust in official narratives when lived experience no longer matches government messaging. That erosion of trust becomes dangerous because confidence is the foundation supporting fiat systems. Gold and silver historically become attractive when populations start questioning the credibility of institutions. The shift does not happen instantly. It builds gradually through repeated disappointments, policy failures, and economic instability. Most investors remain complacent during early stages because they assume authorities will eventually restore normalcy. But sometimes systems reach points where returning to previous stability becomes impossible without massive restructuring. The hidden opportunity today comes from recognizing that the world may be entering one of those transitions. The financial system faces pressures unlike anything seen in generations. Debt, geopolitical fragmentation, inflationary forces, and weakening confidence are converging simultaneously. Yet, despite these warning signs, the majority of investors still behave as though traditional assumptions remain permanent. They continue chasing paper gains while ignoring the slow erosion happening underneath the system itself. Those who understand the role of precious metals during these periods recognize that the opportunity is not merely about profit, it is about preparation. It is about positioning before public awareness changes. Because once the crowd finally realizes something fundamental has shifted, access to physical metals can tighten rapidly, prices can move violently, and emotional panic replaces rational thinking almost overnight. For decades, the global financial system revolved around one central belief. The US dollar would remain the unquestioned foundation of international trade, reserves, and economic power. Governments trusted it, corporations depended on it, banks held it, and populations around the world measured wealth through it. Entire generations grew up believing the dollar-based system was permanent, unshakable, and too powerful to ever face serious competition. But beneath the surface, something has been quietly changing. A shift has begun that most ordinary investors still fail to understand. Nations are slowly moving away from dependence on paper currencies, especially the dollar, and they are doing it far more aggressively than the public realizes. This transition is not happening with dramatic headlines every day. It is not always visible on television or discussed honestly in mainstream financial conversations. Instead, it is unfolding through trade agreements, reserve diversification, commodity settlements, central bank purchases, and strategic alliances between nations that no longer want their futures tied entirely to one currency system. The average person sees isolated news stories and assumes they are unrelated, but when viewed together, the pattern becomes impossible to ignore. History has always shown that reserve currency dominance eventually changes. No empire, no financial system, and no paper currency has lasted forever. Every dominant currency throughout history eventually weakened because the same cycle repeated again and again. Economic power creates confidence. Confidence increases global adoption. Adoption allows governments to expand debt and spending. Over time, that debt grows beyond sustainable levels. Currency supply expands too aggressively. Trust begins to decline. Other nations search for alternatives. The transition away from the dominant currency begins slowly, then accelerates once confidence breaks psychologically. The reason most investors do not see this coming is because they assume today's system is fundamentally different from the past. They believe modern central banks possess tools previous generations lacked. They trust policymakers to maintain stability indefinitely. But despite technological advances and financial innovation, human nature remains unchanged. Governments still overspend. Debt still compounds. Political leaders still prioritize short-term survival over long-term discipline. Central banks still face pressure to support economies through money creation whenever crises emerge. What makes the current situation especially dangerous is the scale of global debt. Nations around the world accumulated extraordinary liabilities over the past several decades. Instead of allowing economies to reset naturally after financial crises, policymakers repeatedly injected more liquidity, lowered interest rates, and expanded borrowing even further. Every crisis became an excuse for more debt creation. Every slowdown triggered additional monetary intervention. The result is a system now dependent on constant expansion simply to maintain the appearance of stability. Other countries have been watching this closely. They understand the risks of relying too heavily on a currency tied to a nation carrying enormous debt obligations and political instability. They also recognize the geopolitical power that comes with reserve currency status. When most global trade flows through one currency, the nation controlling that system gains extraordinary influence over sanctions, banking access, international finance, and economic pressure. Many countries no longer want to remain vulnerable to that level of external control. This is why nations have increasingly started building alternatives. Some are creating bilateral trade agreements using local currencies instead of dollars. Others are increasing gold reserves at record levels. Major commodity producers are discussing energy transactions outside the traditional dollar system. Financial alliances are emerging between countries that historically operated separately. These developments may appear gradual today, but they reflect something much larger underneath: declining confidence in the long-term stability of the current monetary order. Gold sits at the center of this transformation because, unlike fiat currencies, gold carries no counterparty risk. It cannot be printed by politicians, it cannot be inflated away through policy decisions. It has survived every major monetary experiment in human history because it represents value independent of government promises. That is precisely why central banks continue accumulating it aggressively, even while publicly defending fiat systems. Most retail investors misunderstand central bank gold purchases because they interpret them through the lens of short-term trading. They ask whether gold prices will rise next month or next year. But central banks think differently. They prepare for decades, not quarters. When they increase gold reserves, they are not making speculative bets. They are strengthening financial security against long-term uncertainty. The scale of these purchases reveals that governments themselves understand confidence in paper systems is becoming more fragile. Silver also plays an important role in this shift, though for different reasons. Silver has historically functioned as money alongside gold for thousands of years. At the same time, modern industries depend heavily on silver for technology, electronics, renewable energy infrastructure, and manufacturing. This dual role creates unique pressure because industrial demand competes directly with investment demand. As monetary instability grows and investors seek protection outside fiat systems, silver markets could face extraordinary stress due to limited supply availability. The average investor still sees precious metals mainly as outdated commodities rather than strategic monetary assets. That perception exists because decades of relative financial stability conditioned populations to trust digital wealth and paper assets. Most people today have never experienced a true currency crisis. They have never watched purchasing power collapse rapidly in real time. They assume banks will always function normally, markets will remain liquid, and governments will maintain control. But history repeatedly shows that confidence can deteriorate much faster than expected once populations begin questioning the system itself. One reason the shift away from fiat currencies remains hidden is because governments cannot openly encourage distrust in their own monetary systems. Confidence is essential. If populations suddenly lose faith in paper currencies, financial instability accelerates rapidly. That creates a powerful incentive for officials to minimize concerns, redefine inflation metrics, and maintain public belief that current problems are temporary rather than structural. But ordinary people are beginning to notice changes regardless of official narratives. They see rising living costs, they experience declining purchasing power, they watch housing affordability collapse in many regions. They notice wages struggling to keep pace with expenses. Even when markets appear strong on paper, many families feel financially weaker in daily life. This disconnect between official optimism and lived reality gradually erodes trust. The silent shift away from fiat currencies is not only happening internationally, it is happening psychologically within populations. People are starting to question whether paper savings truly preserve wealth over time. They are realizing that inflation quietly transfers purchasing power away from savers toward debtors and governments. They are recognizing that central banks often respond to crises by creating more currency units, which further weakens long-term value. Cryptocurrency emerged partly because of this growing distrust. Many younger investors turn toward digital assets because they no longer fully trust traditional financial institutions. While cryptocurrencies differ significantly from precious metals, both reflect a broader search for alternatives outside centralized monetary systems. That trend alone reveals how confidence patterns are changing beneath the surface. What most investors still fail to understand is how rapidly sentiment can shift once critical thresholds are crossed. Financial systems often appear stable right before major disruptions occur. Confidence creates inertia. As long as most people believe the system works, they continue participating normally. But once trust begins breaking broadly, reactions can become extreme. Capital moves quickly, safe haven demand surges, governments impose emergency measures, markets reprice violently. This is why the current accumulation of gold by central banks matters so much. It signals preparation. Nations understand that the world may be entering a period of monetary fragmentation where trust in fiat systems weakens significantly.